I'm Jonathan Zamanovich. I'm a partner at PMP Strategy, which is a strategy consulting firm with a strong focus on digital infra and notably on data center. Very happy to have, by the way, received an award yesterday for that. The purpose of today is not talking about, is going to be to talk, and that was the last point of the panel, is with the current COVID crisis and the extreme, which is combined with the extreme needs in capacity fueled by AI, which generate massive needs in terms of capital from both the private, the public sector to finance this growth. The idea is to discuss with the very good panel that I have here, and I will let them introduce themselves in a second, about the different in navigating this private market sector with requirements from different stakeholders, both in terms of ESG and in terms of financing, and where and how to on which asset class and which strategy to place the money and to have the best return. So just to introduce the panel, I have the chance to have two distinguished bankers, one happy investor who just cleared a deal in the data center space, and one other distinguished CFO from a global data center company. So we'll let them introduce themselves, and thank you very much.
Shall I start? Being the only woman on the panel, I'll take the first. So good afternoon, I'm Laurent Seno, I'm a Senior Managing Director at Evercore. I focused on communication and digital infrastructure. At Evercore, we're focused on advisory in particular, but across, debt as well as equity, in addition to mainstream M&A.
Hi, good afternoon. Sean Tiaremian, I'm a partner at PwC. I run a practice that focuses on technology within mergers and acquisitions. So our clients are pension funds, large private equity funds, mid-market funds, and some other corporates. We do a lot of technology due diligence, a lot of technology advisory into technology deals, and advise on both technology companies and digital infrastructure in those companies.
Hi, Luca Egidio. I'm a Managing Director at Jefferies, an investment bank that runs. I run the digital infrastructure practice at Jefferies in EMEA and across all the products, which is equity, debt, and M&A.
On my side, Gonzague Boutry, I'm leading digital infrastructure at Ardian. Ardian is one of the largest private equity firm in the world, and I think the largest in Europe. Within that field, we are very active on infrastructure, and notably digital infrastructure, where we have deployed 6 billion over the last 5 years. Across the whole value chain, data center, the recent acquisition that we successfully did on Verne, and then fiber towers. So we have a presence across the various and the whole value chain.
Good afternoon. I'm Ilke Holst, SVP Corporate Finance at EdgeConneX, responsible for raising the capital to build our data centers. EdgeConneX is a data center developer operator. We are developing data centers across the globe, main regions being the US, Europe, and APAC.
Thank you. Just so let's maybe start with the first question that we raised when we have this topic is, what about the impact of the challenging macroeconomic environment and the fact that we are under several crises on the private equity and the infra fund. So perhaps for this part of the discussion, maybe, or banker friends can maybe start. Laurence, maybe.
Yeah, I mean, and that's obviously a very, very important question, and I will take it in different layers. First, I think when it comes to infrastructure, the macro environment has re-rated that asset class. I think it has proven that it's pretty resilient vis-à-vis providing a natural hedge on inflation, vis-à-vis providing visibility on contracted revenues, pass-through pricing. So all of those key characteristics have further, I would say, exploded in terms of ability to attract capital under this macro environment. And I would also highlight that the capital that is being attracted is more and more private in nature. We've seen private credit funds on the debt side increasing the amount of capital they were able to raise. The features that they were also able to provide for various infra-digital asset classes, be it portability, be it longer period for drawdown, as an example. So we feel that the macro environment is a catalyst to see more of those deals. Conversely, we also see that it's taking more time for deals to happen, and that creates more, I would say, due diligence requirements, and of course exposes deals not to get signed or closes. So the macro environment is not being ignored through the life cycle of investments for that matter. And then last observation is on the equity side. We are seeing that it's going to be probably a record year in terms of capital being raised in the primary side. And when it comes to infrastructure, it's about 4 times what has been raised in the past, at least according to our information. And one new phenomenon is much more GP-led continuation fund, which provide another, exit route to expand the duration of holding period of assets within portfolios. So, all in all, a micro environment where the asset class so far has been able to navigate across, with much more attention provided in certain phase of getting deals done, but still being optimistic on the asset class across funding.
Yeah, I think Laurent hit the key points. I think the major issue for the sector in terms of private equity and infrastructure has been that the new environment has created a disconnect between buyers and sellers of value. And that disconnect has been difficult to bridge in 2023. And so it's a simple equation, right? When you don't return your money, and consulting is best, right? When you don't return your money to your LPs, they cannot reinvest in a new fund, and you get stuck. Plus, there was the denominator effect because the equity market tanked. You created this situation where you try to bring to market some good quality assets, they didn't reach evaluation, and the sellers did not sell. That is clearing up because people have come to realization that right now, I think there's new investments coming in, and returning capital at a decent return is better than not returning capital at all. And so that's a point number 1. Point number 2, I do strongly believe that the private capital will continue to grow, but it will be in a different direction. I think Laurent made a very good point. If you look at the largest fund, Ardian, KKR, Blackstone, and so on, they will not grow massively on the private equity side. Where they will grow on the private credit, hybrid solutions. And so I think it's up to us, especially advisors, to be more creative than just trying to shop a company and sell it, because it's in the next 5-10 years we will find massive growth drivers in the sector, but transaction will be different. You probably have seen the core wave transaction. They got $7.5 billion. It was debt. It was not equity. It was structured debt. And so I think the market is great. It's not the macro environment. Digital infrastructure, especially data centers, will continue to grow because the tailwind is there. It's just providing or readjusting the capital structure to the design of the system that what we all together need to do in this industry.
And Gonzague, maybe one thing from your perspective, did you see any impact from this macroeconomic environment on fundraising?
No, it's a good question. So currently we are raising our sixth generation of European fund, which we target 10 plus billion. To give you a sense, let's say that follow Fund 5, which was 6 billion, so increase in the fund size. I think what let's say the major difference between let's say the fundraising of Fund 5 and Fund 6 is the timing. So what has been said on single transaction, we are seeing that also at let's say at the fund level, where before you were large fund like KKR and so on, were fundraising in a fund within 6 to 12 months, depending on the period, depending on the momentum. Now it takes more 18 months to 2 years. The correlation, the link with that, and my next point is we are also seeing a flight to quality, meaning that let's say the top tier, and I think we can also translate that at the company level. Let's say the top tier fund can attract a lot of capital. I don't think this is the case for let's say tier 2 and tier 3 asset, because simply let's say the large investor prefer in the moment where there is more volatility, there is more risk, there is more geopolitical uncertainty, back let's say their top tier name, and that's why I think we still see massive liquidity and massive cash coming from our clients. And I agree with Laurence, it should be a record year of fundraising, hopefully this year. So I think that's a two trend. It's more energy, more time that you need to put to fundraise, and also clearly flight to quality. So I think that's the two trends we have seen over the last 2 years since let's say the start of let's say this more shaky geopolitical environment.
Thank you. Now, it raised another question. Is we talked about the market. What are the potential in terms of long-term growth? Because we know that there is, I would say, a secular need for further investment, and as you said, Laurence, it's probably coming from the private markets. So, what is your view on the factor, the key success factor? Maybe, Sean, maybe if you want to start on what is the growth of, or do you see the market going in the coming years?
Yeah, maybe just to start. I mean, I think as has been mentioned, there's lots of tailwinds. These tailwinds are have been there for the last 10 years in terms of digital infrastructure as it's evolved. The question is, what does it look like going forward? I think with the advance of technology, the dependence on data, on AI, all these things we've heard of many times today. There's some very good tailwinds. I think that the prospects for long-term growth is good, and I welcome comments from the others. But I think it changes, right? What we're investing in today and what we're advising on investments today doesn't necessarily mean it's going to look like that in 10, 20, 30 years. Technology is advancing, data is becoming more and more. The need to analyze that data, assess that data, develop AI use cases and applications for that data is going to change. that's going to have a upstream effect on the digital infrastructure that's supporting it. So I think there's lots of good long-term growth in this general asset class and this general sector. I think, though, that there's a responsibility to be cautiously, I'm not going to say pessimistic, but conservative about the capital needs that are going to be a requirement going forward for it.
And Gonzague, which type of class A do you think that you're seeking today and you're potentially going to seek in the future?
In terms of asset class, I think what also is fundamental vis-à-vis our clients is to deliver, let's say, the best portfolio. And the best portfolio is not having deployed 5 billion on fiber, and that's it, even though, let's say, the underlying asset can be great. I think what we are super focused on is to deliver a diversified portfolio, which is diversified by few means. One, obviously, is subsector, and that's why I think our last acquisition, Verne, was important, because now we are present across the whole value chain. Diversified by country. You want not to be. You want to be spread across Europe. Also having exposure also to the US, potentially Asia. So you want. And for clients, they are obviously investing in Ardian infrastructure, so they are more focused towards Europe. But I think it's really important to be spread over Europe. And the last one is, let's say, the company profile and the maturity. Obviously, between Inuit, which is one of the largest TowerCo in Europe, 10 billion market cap on the stock exchange, and then Verne, which is more, let's say, entrepreneurial story, growth story, and so on. I think those are a great mix, and I think definitely it's not that we are trying to be, let's say, again, diversify again across that. So that's, I think, what we will look over the next years. Not only one sector. We'll try to let's say leverage a few opportunities on each of the subsector and trying to pick the best asset. And I think it's obviously it's a moment where we can enter. And I think, let's say, the moment is quite interesting, because you can do a very nice transaction at still, I think, good multiple, because let's say the re-rating that we discussed before. But it's also a matter of making sure that, let's say, over the life of the investment, you deliver, let's say, the growth, and it's a matter about asset management. And I can tell you, as an investor, I spend most of my time not only on new transaction, but, let's say, making sure that, let's say, we deliver the business plan that we promise to our clients. So I think that is the second part, fundamental part, is making sure that you create value, and obviously at some point you need to exit, and exit at the right time. But to exit at the right time, you need to have, let's say, deliver the business plan that you have underwritten at the beginning, or overperforming.
And talking about delivering growth from an asset perspective, I'm going to Ilko, because that's what you're there at EdgeConneX to deliver. So can you tell us a little bit how you experienced the fantastic growth that you planned for Encounter over the last years, and how do you see the future going forward?
Yes, so what we have seen is that indeed I think the speed of the growth has only increased in the last couple of years. I think we have outperformed our 5-year plan every time around, and I think we'll be doing that for the next decade. But we also see that the life cycle of the projects is changing, because the nature of the market is changing, in the sense that land is scarce, power is scarce. So where I think a couple of years ago, when I was still in banking, we would be looking for projects where we would sign the credit agreement at the same time with the customer contract and buying the land, etc. Nowadays, the life cycle of these projects is much more stretched, and that is what we have been focused on in EdgeConneX for the last 4 years, supported by our shareholder. It's making sure that we control land and power far ahead of starting developing the data center, because our customers today demand that we control land and power at the moment that we start even responding to their RFP. So also if you look at my responsibility raising capital, that means that we need to also be more creative and working with our lenders to structure around a different type of project, which means that we need to leverage also land investments, we need to leverage power investments. We have built our own substations to work around congestions in certain regions. And to be able to still make the returns that our investors require from us. And that is with big deals getting bigger, the growth increasing, we need to become more creative, we need to tap into new pockets of capital. That means educating different types of lenders, but also using different products to tap into different markets.
Thank you. That's a good transition towards my next question, which was, what are the opportunities and the strategy to achieve those opportunities? Mostly, of course, you have all in mind AI, because we're talking about that since more than 2 years now. But beyond that, what are the opportunities and what are the different financial strategy? Maybe that was the continuation of what you were saying, Elko, about how to raise money and how to structure deals.
Yeah, I think first and foremost, we need to deliver to our customers. So I think that is critical, and my job is to facilitate and make sure that at least capital is never going to be a constraint for us to deliver to our customers. I think one of the big themes within EdgeConneX and with the growth is that also you need to keep it manageable. So we have, for instance, traditionally used a lot of project finance, but when you're doing multiple deals simultaneously, doing project finance is going to take a lot of time and effort. So what we've been doing is collapsing a lot of our financings into larger funding vehicles, which in itself also allow other type of investors to step in who are less familiar with data centers, but sort of through the transition of using different funding tools are able to access the market. So I think innovation, not just in the data centers, which is obviously critical to answer to the demand of AI, offer the flexibility that our customers require to switch between cloud and AI. We need to be as flexible and creative also on the capital side.
And from a tech perspective, Sean, what do you see as the upcoming opportunities?
Yeah, maybe less so on funding, but more, we spend a lot of time focusing on EBITDA, right? And how to improve EBITDA through the life cycle of an investment. And with data centers, it's very unsexy stuff, but it really is about, automation, reducing, optimizing your power consumption in a very aggressive power demanding environment. Making sure your cybersecurity provisions are not overly not over-indexed, but indexed enough to the operational needs of the business and to the threats that are coming out. So there's a number of technology drivers that help reduce operating costs, help drive EBITDA, but ultimately these can be not just incremental, they can be incremental to EBITDA improvements, but ultimately on exit it produces a better value. So those are a few examples of the type of technologies we focus on.
And Gozak, from your perspective, do you see any other opportunities beyond what you just mentioned, in terms of financial strategy or into asset class to seek for?
I'll come back first on financing strategy. I think from EdgeConneX, also you have here that. I think, let's say, the most important thing is, let's say, operation, and you need to deliver, and your client need to be satisfactory. You need to deliver growth on the operation side, and that should be almost 100% focus of the shareholder the management team, and then obviously if at a certain point of time you are, let's say, capital constrained in order to deliver that, then you may think more about splitting the business between yieldco, devco, things that we have seen. But let's say my primary focus as a shareholder of the company is clearly the operation, and in a way clearly the financing is, let's say, in a second layer. Is nice for our banker friends because it allows them to finish, let's say, the P&L of their year. And again, this can be, I'm not saying it's not relevant, but let's say again, the primary focus is making sure that, let's say, you deliver the business plan. And delivering the business plan is as simple as revenues, EBITDA, and capex, free cash flow. So that should be, let's say, and that is, let's say, my driver on the day-to-day as a shareholder.
Luca, Laurence, do you want to add anything?
No, I think Gonzaga is right. I think where I think Laurent and I are most helpful to them is 2 pinch points. Number one is when things go a little bit sideways, how can we help them go in the other direction? It can be through a number of strategies, right, which include expansion, M&A, and so on. But also, our objective is to help them to deliver above market returns, which means, I think Gonzaga mentioned before that you can diversify your portfolio through asset classes, but right now you can do also within the asset class, within data center at some point, asset reach maturity, and the cost of capital becomes too high to continue to own the type of asset. At some point you have project finance, but the type of debt becomes too expensive and you flip it to ABS. I think that's where we stand by Ardian and the other infrastructure fund to help them deliver their returns so they can focus on what's the core, which is deliver the business plan and make the clients happy.
Yeah, no, I fully concur with Luca. I would say, in effect, we kind of are a bridge to execution once a transaction is done. We kind of try to create new source of capital. At some point, would the public markets be ready to host an exit of a scalable data center? Is it a similar question that one has to ask himself or herself about fiber? So kind of trying, in the meanwhile, educate is a strong word, but see how much of a private to public bridge they can be at some point, because all of those objects in the good hands of the Ardian and the like are gonna be growing, and at some point there needs to be the next phase of holding and approach to the underlying fundamentals. So that's a bit of the work as well that we all do.
Thank you. Going back to the opportunities, but I would say more from a commercial perspective. Do you think, because everybody has in mind the classical Microsoft, Amazon, Google, all those words, but there is a new class of clients that we see, and also a new kind of development beyond hyperscale. Potentially, maybe Ilko, if you want, or Shant, if you have any perspective on that.
Yeah, I can kick that one off because it's definitely a topic. So I think you see on the back of AI some of the derivatives from NVIDIA, like CoreWeave. Everybody's talking about that huge financing that they've done, but and we have deployments of these new companies in some of our data centers, but their capacity requirements are growing, and what the market and the market being, I think, both on the delivery side, but also on the funding side, needs to get our head around. It's like, if these type of clients are going to buy like 100 megawatts at the same time, like in Microsoft, where I think everybody has grown accustomed to AAA rated offtake contracts, which work very well when you're in front of a credit committee, I know. But there is another type of customer out there, and we can't always diversify away that exposure in a large portfolio. So that is definitely something that, together we need to find solutions for to make also these type of projects possible.
I'll just add, in terms of customers of data centers, I mean, if you look at the use of data centers from enterprises, from companies, you're starting to see a mix of, the Amazons, the Microsofts being used for, large applications to host their kind of enterprise applications. So all of that is going in that direction. There's other components of their technology landscape, of their data hosting needs, of their analytics needs, of AI applications and use cases that have the potential for use in other types of data centers or other tiers of data centers. So I think what we're seeing is, along with all this talk of edge computing and having lower tier data centers closer to the end use, I think you're actually seeing uses of data centers that are not just about the hyperscalers and the AI data centers. There's other tiers of data centers that are continuing to be useful and helpful. So I think we're seeing that evolve in the technology landscape of corporates and how they're using data centers. I think that creates a really interesting dynamic that is transitional in nature, but seems to be moving towards a tiered need, a need for different tiers of data centers depending on the class of application that it's using.
Much more from I would say edge data center, and one question, because the edge data center tend to be, I would say, a smaller transaction. So could we assume that this market is probably for other pockets, or what do you see in terms of appetite for those smaller platforms for Luca and Laurence because there were plenty on the market. Not everyone has been successfully trading. So
That's funny.
Who starts?
I'm joking because he get a mandate on this one.
No comment. Look, where I start. Look,
Yeah.
I think so. I think it's all about the property. Is really right. The specific application fits well in specific type of workloads. If you look at historically, a lot of these assets were telco assets, and they have a lower power density. They fit well some application. There's a little bit of a misguided view of the world where everything is going to go to cloud, and that view of the world, I just don't embrace it, because if you are a SaaS application which is very elastic, that fits perfectly well on public cloud. But if it's not the case, the SaaS application, and it's more like traditional, it's going to cost you much more, and we see actually a return towards traditional hosting environments, right? Plus, if you are dealing just with Microsoft, Google, or the hyperscalers, you are dealing with the client that price these contracts to perfection, which means your ability to generate above market returns is diminished. So I think there's a lot of additional capacity, additional infrastructure that can serve well specific applications which are location and latency sensitive, are very market focused, and there are big platforms being built. There's a platform called Atlas Edge that everybody knows, which was seeded from Liberty Global. So, and there's new platforms coming up, and I do believe that ecosystem, when they build edge capacity and next to it they complement it with hyperscale type of sites, I think it's a fantastic type of playbook. Burn is more like HPC. I think that's a fantastic playbook. And so the view of the world where Microsoft, Google, and Amazon will dominate everywhere, I think is a bit misguided from my standpoint. I don't know what else you think.
No, I agree, and I would say maybe with Edge, to your point, Luca, you need to start with a conviction. And it's probably more difficult, all things being equal, than starting with an hyperscale angle where it's all about embedded growth, etc. You have to believe into the end game model. So you have to take a view on technology, you have to take a view on scalability or need to scale this type of business. Do I go one country? Do I go pan-European? So there's a lot of upfront fundamental work that you have to do. I think the world where you bypass everything, I agree with you, probably doesn't exist, or at least I also don't believe in it. The requirement to have high compute capacity next to premises that are going to be more and more urbanized, it's probably the end game. The question is the speed at which you get there, number one, and number two, how much of those premises you need to reach that level of compute. But a model where that doesn't exist, I think personally as well, I don't buy it. Do you need to go hybrid in this interim phase where you do a bit of hyperscale, or you started with a large edge approach and you try to get much more colo as part of the offering, just to make sure that you navigate this period where the end model is being defined, possibly, but the end model will prevail. And Atlas Edge is a good example. The other one is Enlighten, which has been created in a different way, but they all converge towards the same approach. And I think there will be more supply coming, and then it's going to be about tiering that supply out of the telcos as to what makes sense in between a true edge proposition out of what at the beginning is essentially technical side.
I will just add one thing. I think my friend banker has been very good about let's say marketing, because at the end they call it edge, what it used to be local
technical side,
technical co-location side for a small enterprise. And as an investor, I look at those opportunities, and I tend to agree. There is demand, and there will be demand, because you cannot put all, or you can put everything on the cloud, but it's also a matter of cost, and that's not obviously cost efficient. But let's say the real edge, as you mentioned, Laurence, it will come one day, and I'm convinced it will come. The question is at what terms, at what condition, and at when. So as an investor, like promising, let's say, long-term stable investor for our clients, there would be a switch, at least a partial switch. I'm not saying like, let's say, all your clients would switch from small enterprise to Netflix or to Tesla or to those things. For sure not. You will have a mix of everything. But at least for some of part of, let's say, the capacity, in 10 years from now, I'm sure it will be taken by, at least on some side, edge side, by those Netflix or really low latency sensitive, because today, let's say, the client of the edge are not low latency sensitive, they're just a small enterprise that they want to have, let's say, their compute just close to the office, just to check that if they need to change the server, they can easily do it, as simple as that. So I think what is difficult as an investor is let's say, this partial switch of business model that will happen at some point, and at what condition. But and that's why we have not invested into the field for the time being, because like there was uncertainty about, let's say, this part of, let's say, the business plan.
All right, I think our time is up. Thank you very much to the panelists. Thank you for this great discussion, and looking forward to see those things materialize.
Sorry?